Welcome to Loans Part 2. In this lesson, I'm going to talk about the remaining balance on a loan. We'll derive the associated formulas, and then we'll talk about refinancing the loan and the various decisions involved in that. And I also have a Python program for each of these two topics, which I'll discuss towards the end of the lesson. We previously derived the formula for the balance on a loan at the end of a given period. That was in the last lesson, and I'm showing that here again. B sub k equals this quantity, and then we use the formula for the sum of a geometric series, a finite geometric series, to get this. And so this is something we've derived before. What I wanted to show here, there's another approach to finding B sub k, and that is to sum the present discounted value of the remaining n minus k payments at time k. So that's these here. It's just how much value each of these payments would accumulate if at the by the end of the loan. And so that's the present value calculation. So that would need to equal b sub k. Then we factor out an a times 1 plus I to the minus 1. And we get another finite geometric series. And we use the formula for the sum of a finite geometric series to get this here. Then I note that the denominator, if you work the algebra, which is not too hard, you get I plus I over 1 plus I, and you plug that in here, and you get this expression here. So these have different advantages. This first formula will work even if you have a balloon loan where you have a final payment is irregular, and we did make use of this when we computed the formulas for balloon loans. The second formula does not work in that case. However, the second formula, as you can see here, does not have a p in it, so you can use this in the event that for some reason you don't know the principle that you started with in terms of the loan. On the next slide, I'll show that these two are equivalent. So let's show that two formulas are equivalent. At the end of the loan, the focal date that we'll use here, the dated value of the debt, this quantity here, minus the dated value of the payments, this quantity here, should equal 0, right? Because by the end of the loan, you've paid everything back, and that should equal however much the principal had accumulated by the end of the loan. And then we just use the formula for a finite geometric series, plug that in here, and then I just subtracted that from the other side. We get this here, and then we solve for p, so we divide this into both sides, and we get this here. And then we subtract this from both sides. We subtract this quantity from both sides of this. You notice there's a k here and an n here, so they're not the same. So subtract this from p, we get that, and we subtract this from here, we get this. Then these have a common denominator. The ones cancel out, and you get this expression here. And then you multiply by 1 plus I to the k on both sides here. And you get this on this side. And you notice on this side here, the 1 plus I to the k, that just makes this a 1. You get this expression here. And that's what we wanted to show. These are the two different expressions that we had on the previous slide. On this slide and the next few slides, I want to talk about refinancing. When interest rates drop, it's not unusual for people with existing mortgages, for example, to consider refinancing. Refinancing entails the termination of an existing mortgage, perhaps with a penalty to pay, and the initiation of a new mortgage, which also involves various costs, for example, legal fees, an application fee, a title search, local taxes, and an appraisal fee. A typical goal for the borrower is to lower monthly payments and to reduce the amount of interest paid over the remainder of the mortgage from the time of refinancing. So I have an example here, and I'll also do this same example using a Python program that I wrote. I'll show you that a little bit later, but we'll come up with the same results here. So, for example, the Butterfields have a $300,000 30-year mortgage that is repaid monthly at 0.005 per month. That's 6% nominal annual rate. Exactly 5 years into the mortgage, they can obtain a 30-year loan at 4%. And the monthly rate would be 0.04 divided by 12, so it's 0.0, and the threes are repeated indefinitely. So, and we need to be careful here, as I explained in the previous lesson. If you truncate too soon, you'll actually get the wrong answer, at least in the cents, even in the dollars sometimes. So when I show you the program, I'm actually going to put 8 threes in here when I enter that, and that'll give us the numbers that we have down here, but let me get to that in a second. So assume the total cost of terminating the existing mortgage and taking out a new one is $6,000. I don't know if that's realistic or not, but I just picked a number. Does it make sense for the Butterfields to refinance? So if we put all this information into the calculator that I have, and I'll show you that a little later, these are the results that'll come out. So the balance on the initial loan is this amount here. So that's after the 5 years, you still have this much money owed in principal. The periodic payment for the initial loan is $17.98.65, and the periodic payment for the new loan using this new interest rate is much less, $13.32.77. The remaining payments on the initial loan, if they do not refinance, equal this number here, of which this amount is interest. The payments in the refinancing scenario, including the cost to terminate the initial loan and to start the new one, equal this amount. So they're saving quite a bit there, and we already know that the monthly payments are less. The interest paid in this scenario is also less for the remainder of the loan. It's $200,633.12, and it will take 13 periods to recover the cost of refinancing. Assuming the Butterfields do not sell the house before they recover the $6,000 in refinancing costs, refinancing makes sense. So this is just one analysis, and with the tool that I'll provide you, you can play around with different numbers. You can change the the cost here of terminating the existing mortgage and creating a new one. I did another 30-year mortgage on top of the first one, so that would be 35 years in total that they're paying a mortgage on their house. But you might want to try 25 years, so that you started with your 5 years, you refinance, and maybe you just want 25 years after. So you can play around with that when I show you the tool, and I will make that available on GitHub, and I'll give you the link in the information to this video. This is the first of 2 short videos that I'm inserting into my larger video concerning the loan refinance toolkit. There's 2 different features here. There's the single refinance, which I'm going to do now. Then I'll come back and do a second short video on this break-even rate table. So we're going to use the example that I talked about was the Butterfields. We'll put in the initial loan amount, it was $300,000. Then the interest rate, not percentage, but rate. So we need to convert that. Number of periods, that was 30 years. So it was 12 payments a year, so 360. Then they decide to do the refinancing after 5 years, so 60 periods. And then we decided that the refinancing cost was $6,000. You can play around with this when you download the tool. Then we want to put in the new interest rate. And remember the caution I gave you about using a lot of decimal points, a lot of decimal places. So I'm going to use 8 threes here. And then the new loan is also 360 periods, months basically. Okay, so we have all the information, and this will give us the same information that I discussed in the example. You can see here, this was the balance after 5 years. This is how much money was still owed. This was the amount the Butterfields were paying per month, was the existing loan, and then if they refinanced, they would be paying this much a month, was the new loan. Then I have the remaining payments, if not refinanced, would have been $539,595.47. Then the interest portion, $260,000 and some additional money there. And then the refinance total payments, $485,000. So you see it's quite a bit less than if they did not refinance. The interest portion, of course, would also be less. And it'll take 13 periods to recover the $6,000 here. Okay, so that's it. If you wanted to play around with this, you would just clear, then you could put in your own numbers, and then you could do it over and several times and experiment with the tool. A natural follow-up question is, at what interest rate does the refinancing still make sense? So we saw when it went down to 4%, it still made sense, but maybe they don't actually have that in hand, and the Butterfields are looking at different banks and seeing what interest rate will actually save them money over what they're doing right now. And the second part of the tool that I'll present to you has a capability to examine that. And I did one run, which I'll show you on the next slide. The table, it's the output from that. So the table on the next slide lists total payments for the new loan and the payment per period here per month for several interest rates, beginning with the rate on the existing mortgage. That will be at the very top. Total payments for the new loan stay below the remaining payments on the existing loan up to the nominal annual interest rate of 4.9%, but below the 4.96%. So let's have a look at that table. So the top line here is the current situation. The Butterfields are paying this 0.005 rate per month. Nominal rate is 6%, and the total payments is this number here, and this is how much they're paying per month. And then the calculator will keep, it'll start at some rate, and it'll keep advancing that until you hit this crossover point. You notice here is what they would owe given their current mortgage, and this is slightly less than that. So this may not be enough for them to make a change, but it is slightly less than that total. But the monthly payments are a good bit less, so that may encourage them to make a change. But when you come to the this next increment here, you notice the total payments are more, although the monthly amount is less. So that might be a harder decision to make if they're a little bit squeezed for money on a monthly basis. They may want to go to this, even if in the long term it's costing them a little bit more money, over the 30 years. So the tool I have will do this for any situation. It doesn't always compute the same number of things here. You give it this input, and then it keeps computing until you cross over where this total payment amount is more than what you had. Okay, so in the next couple of slides, I'll explain it's one program, but it has two features in it. One feature is just the basic refinancing computation when you know what the new rate is. And then the second feature is where you don't know what the new rate is and you're curious at what point would it make sense for you to jump in and do a refinancing of your loan. This is the second aspect of the tool that I want to show. We already went through the result of using this tool on the previous slide, but I just want to show you how to make use of the tool here. So there's two options up top. This is the break-even table. So you start at some interest rate less than what you're paying, and you want to increment it by small amounts from some starting point until you hit a crossover point where the remaining amount of payments are more than what you're paying now. And at that point, you know it wouldn't make any sense to do a refinance. So we'll put in the same numbers, the 300,000, the 6.06 divided by 12. That's the current rate that Butterfields are paying. And then it's 30 years or 360 months. And they decided to look into refinancing after 60 months, 5 years. And the refinancing cost was $6,000. The number of periods per year in this case is 12. We need this only because of the output is going to be in terms of annual interest rates. So we need to put this information in here. Then we're going to go for another 30-year mortgage. These two don't have to be the same. We could have gone for 25 years and put 300 in here, but that wasn't the example we did, so I'll just stick to what we did here. Then we want to do the start rate. So we'll start at 4%, and then we'll let the program compute increments above 4% up until we hit the crossover point. And so 4% divided by 12, we did that before. The threes repeat indefinitely, but this is probably enough. And then this is the increment. This will work well if you're doing 12 per year. If you're doing like quarterly, then you would need to adjust this number here. This is just the math notation, 5 times 10 to the minus fifth, so it'd be 4 zeros and a 5. And that gets divided by 12 in the program. You don't need to do the division here. Okay, so you notice here this number divided by 12 is just going to give you an increment of, in terms of yearly rates, 0.06. You notice it keeps increasing. And what we want to test is for when the initial remaining amount of payments, this number here, is crossed as we increase these interest rates here. So the user interface only prints out part of the table. The full table gets here. And unfortunately, to actually see the crossover point, you need to see these last 4 rows. But you can see it's growing. And as we saw in the chart that I talked about in the last slide, you get up to, what was it, 4.9 before you hit the crossover point, in which case it definitely makes no sense to be paying, at least in terms of the total payments, but the monthly payments will continue to be less than the amount you're paying here. So you could possibly even go over this total amount and still decide to refinance only because you're going to get monthly payments that are a little bit less. Okay, so that's the second aspect. I'll make the Python program available as well as a executable for Windows. So if you don't know Python, you can just use the executable. You single or double click on it, depending on how your browser, your computer is set up, and that'll open up this interface here. The next few slides have exercises for this lesson and the previous lesson. The first exercise here relates to the previous lesson, which I recopied what we had from there just to remind you. And the task is really to complete the example. So let's look at the example again. As an example, consider a 3-year loan on a car for $10,000 at 3% annual interest rate, where the loanee pays back the loan on a monthly basis. In terms of the above formulas, I'm referring to the formulas I had done in the previous lesson. The principal was $10,000. The interest rate per period was 0.03 divided by 12. The number of periods was 36. Using the formula for equal periodic amortization payment yields, and this is the value here, $2.90 and 81 cents. A breakdown, interest rate versus principal for the first 4 payments, is given in the table below. So this is what I had done in the previous lesson. Given the relatively short term of the loan, the principal payments outweigh the interest payments from the start. For home mortgages, as we just saw, the interest payments are greater than principal payback at the beginning of the loan. So here's the problem. Complete the table and generate the entire repayment schedule using the compute interest principal breakdown feature of the amortization calculator. So I gave you a link to that in the previous lesson, but I can add it again here. All the programs are in a directory, and then there's a subdirectory, dist, for executables, and I do have an executable for this calculator. Okay, so your task is simple. Just use this calculator, and you can even double check it because I'm giving you the first 4 out of the 36 payments. We have a few more exercises on this slide. I'll give you hints and answers in most cases. Assume that a potential home buying couple has determined that they can afford a maximum of $1,500 per month for a home mortgage. Further, they have found the best 15-year mortgage rate to be 3%, the best 20-year mortgage rate to be 3.5%, and the best 30-year mortgage to be 3.75. For all 3 scenarios, assume that payments on the mortgage are made monthly. What is the maximum mortgage initial principal that they can afford? So the hint is solve the equation given here for P, because we want to find the P is the initial principal, and use the derived formula to determine the value for P in each of the 3 cases, keeping in mind that you need this I is the monthly rate per period, so you would need to convert these percentages to decimals, and then N would be the number of months times the number of years in here, and then you have everything else. You have 1,500 is fixed, right? That's the most they can afford, so that goes in for A, and then you just solve for P. And you can check your calculations using the max affordable loan give an interest rate feature and the amortization calculator, which I'll make available. And what I came up with, and you can double check me on this, but I found that the 30-year mortgage, even though the rate's a little bit higher, that would give them the possibility of purchasing the most expensive house, was this number here. Okay, then the second problem, for a $300,000 30-year mortgage at a nominal interest rate of 4% with monthly payments back to the lender, determine the amount of the monthly payments, adjust the monthly payment to the nearest multiple of $10, and determine the final payment in this case. So this was from the first lesson of the two lessons on loans, as well as this one here. And we talked about the rounding up or down, and we had the formula we derived for the final payment. I copied it here, but you can also go back and look at step 4 from the previous lesson concerning rounding. So for the and then here's the answer. For the amortization calculator, we determine the monthly payment to be this amount here. So the adjusted monthly payment to the nearest $10, in other words, $1,430, and the final payment would be a little less than $3,000. If we wanted to just eliminate cents, then the final payment would come to $1,602, again using this formula. And if we adjust it down to the nearest 100, in other words down to $1,400, then surprisingly just paying that little bit less, that $32.25 less a month over 30 years, leaves you with a gap at the end of almost $24,000. Continuing with the previous problem, how many payments would it take if the monthly payment is increased to $1,500? We can use the additional principal payments option in the amortization calculator. We put the additional principal payment to $67.75. That's just the difference between the $1,500 and the number we computed on the previous slide. And since they're going to start these additional payments from the very beginning, then the value for M in the calculator would be 0. And if you plug those things in, you'll see that you'll pay off the loan, the couple will pay off the loan in 330.13 months, so you have to round that up to 331, or roughly 2.5 years early, a little bit less than 2.5 years early. Problem number 5. For a car loan of $30,000 at a nominal annual interest rate of 2% compounded monthly for 3 years, and a balloon payment of $15,000 at the same time as the last monthly payment, how much is each monthly payment? And we can use our balloon loan formula, and it's this here. And if you plug everything into this, you'll get an answer of $454.64. Okay, and if you recall, when we did the balloon loan, there was an option of where you made the last payment and then you paid the balloon amount one period later, and that was a different formula. So that this question number 6 is saying, what about that case? So we did derive a formula for that. It was this here. It's a little bit more complicated. And if you plug all the numbers into that, you get something a little bit more, which makes sense because you're waiting an additional period to pay back the balloon loan at the amount at the end. We have 3 more problems, and then we'll conclude this lesson. So Jedediah, goes by Jed, has a 30-year mortgage in the amount of $5 million at a nominal annual interest rate of 3%, compounded monthly, and with monthly payments back to the bank. How much is the balance on the mortgage at the end of 73 months? So our hint is use either of the formulas for the remaining balance. If you recall, we had two variants of that formula. Check your answer with the loan refinance toolkit with 0.0025 for the interest rate per period using amount 0 in the penalties and cost field. The interest rate and number of periods for the refinance loan are not relevant, but to avoid an error, use 0.0025 and 360. Continuing with the previous exercise, Jed has the opportunity 73 months into the original mortgage to refinance at 1%, nominal annual interest rate, compounding and payments are monthly. The new mortgage would be for 30 years. There is no cost to terminate the original mortgage as written in the mortgage agreement if he uses the same bank to refinance, which he is doing. But the new mortgage costs $55,000 should Jed refinance, assuming he intends not to sell the house in the next 10 years. Okay, and that would, again, you can use the loan refinance toolkit, which I'll make available to you to analyze this. And then continuing again with the previous exercise, what is roughly the highest interest rate above 1% and less than 3%, at which it still makes sense for Jed to refinance in terms of having a lower total remaining payments. And that would be the loan refinance toolkit, but you remember there was a second option there, the break-even rate table. So have a look at that also. Okay, so that's the last slide in this lesson. If you like this, please give me a thumbs up. And I have some more lessons on bonds and some lessons on capital budgeting. And then that'll conclude the series at that point.